Well, hello, and welcome to our Chapter 6 video lecture. The topic is accounting for long-term operational assets. In this chapter, we're going to mainly focus on long-term operational assets, items like equipment, buildings, machinery, automobile. We'll focus on the acquisition of these long term assets, the usage of these long term assets, and the disposal of these long term assets. In part one, we identify and determine the cost of long term operational assets. Okay? There are two types or categories of long term assets, what we call tangible assets and intangible. We'll begin to focus on tangible assets. These assets have a physical presence. You can actually see and touch them. Again, items such as buildings, equipment, land, machinery, automobiles, examples of different type of tangible assets. In contrast, intangible assets cannot necessarily be seen or touched. However, but when you own these intangible assets, you are granted certain rights and privileges, and we'll talk more about that in the latter section of this chapter. Okay? So with the tangible assets, we got two different categories, what we call PP&E, which are your property, plant, and equipment assets, and your natural resources. We'll begin with the PP&E assets, which are also called plant assets or fixed assets. We're going to learn a term called depreciation. Understand what is depreciation and how is it going to be calculated. Then we'll cover what's known as natural resources, whether mineral deposit, oil, gas reserves. We'll talk about how we're going to recognize an expense called depletion for our natural resources. Okay? When it comes to your intangible assets, there are some that have what we call an identifiable useful life, and they go through a process known as amortization, which is similar to depreciation or depletion for your tangible assets. And then there are other intangible assets that have an indefinite useful life. We'll discuss those as well for items such as franchises, trademarks, and goodwill. Now, although these assets are not going to be amortized, they can become impaired. So we'll discuss what does it mean once an asset has become impaired. Okay, that's a lot, but that's like a rundown of what we'll cover in this chapter. So let's begin with our long-term assets, and we're now focused on our fixed assets or your property, plant, equipment asset. When you acquire these long-term assets, we're asking what costs should be included in the asset account. Well, the rule says any cost to acquire the asset, along with any cost to get the asset ready for its intended use, should be included in that asset account. For example, if buying a building, the cost to record could include the purchase price, sales tax, any title search to make sure there's no liens against the property, any other transfer document, any fees paid to a realtor or an attorney, as well as any remodeling costs. All of these costs will be included in the actual building account. If purchasing land, same type of cost, purchase price, sales tax, any title search, realtor fees. So if we purchase land that has a building on it already, but we don't want that old building, then the cost to remove that old building will also be included in the land account. For equipment, of course, the purchase price, any sales tax, delivery costs, if it's being shipped to us, what does that cost? if it has to be installed, what does that cost, and any type of renovations or changes that have to be made for the equipment ready to be used. All of those costs are going to be included in your equipment account. Okay. Basket purchase. What is that? Well, that's when we purchase several assets but for a single price. So we hear about a basket purchase allocation. It means we purchase a group of assets in a single transaction. Now, what we have to do is determine what amount should be assigned to each of those assets. We use a method called the fair market value method in order to determine what portion of that purchase price should be assigned to each of those assets that was acquired in that group. For example, so now get out your calculator. Let's assume that we purchased land and a building for a total cost of $240,000. We want to determine what portion of that $240,000 should be assigned to the building, what portion should be assigned to the land. Well, we had each of those assets appraised, and this is the fair market value of those assets. The building has a fair market value of $230,000, and for the land, its fair market value is $90,000. So we're going to determine each asset's percentage of the total fair market value, and then multiply that times the purchase price. Again, determine each asset's percentage of the total fair market value, and then multiply that amount times the purchase price. All right. So the building fair market value is 75%. So if you took let me go back for a second. So the building was 270. 270 divided by 360 would give you 75%. 90 for the land divided by 360 would give you 25%. So the building represents 75% of the total fair market value. The land represents 25% of the total fair market value. So now you're going to multiply each asset's percentage of the fair market value times the purchase price to get the amount to be assigned to each of those assets. In conclusion, we're going to assign $180,000 to the purchase price of the building and $60,000 to the purchase price of the land. So this is the approach we're going to take when you acquire assets through what we call a basket purchase. Next, the life cycle of an operational assets. First, we need money. So first, we have to acquire funding in order to buy the asset. Once the asset has been purchased, we're then going to use the asset. And at some point in time, once the asset has been what we call used up, we're going to retire the asset. So again, first we need some money, then we'll buy the asset, then we'll use the asset, and next we're going to retire the asset. Okay, so we're going to go through these different stages. We talked about number one. Number one was acquire the funds to buy the asset. That could be through borrowing money, through what we call debt financing, or if a corporation, we may issue shares of stock, which is called equity financing, in order to purchase the asset. And number two, purchasing the asset, we discussed that a little bit already. And here we're saying that whatever cost was used to acquire the asset and to get the asset ready to be used should be included in that asset account. So our focus right now would be on step three, the actual using of the asset. As the asset has been used, there's wear and tear on that asset, and we're going to recognize something known as depreciation. Okay? So ultimately, as it depreciates to the point where they're no longer useful in the process of earning revenue. So we're saying that if we purchase a new equipment, new machine, a new automobile, we're going to use those assets in order to earn revenue for the business. However, there will come a point in time where the asset has been used up. It can no longer provide us with revenue. At that point in time, we're going to retire the actual asset. Okay? So, this term depreciation is a term that you've heard before. But what is depreciation? I'm glad you asked that question. It is, pay attention, the amount of an asset's cost that's allocated to an expense over or during an accounting period. Again, it's the amount of assets cost that's allocated to an expense during an accounting period. Notice it does not say it is a decline in value. From the accounting perspective, depreciation is the process of allocating the cost of a long-term asset into an expense account. Okay? Now, most long-term assets have what we call a salvage value. Salvage value, sometimes called residual value. It is the expected market value of an asset once it has been fully depreciated. For example, let's say that you have a limousine service. You provide limousine services for your client. Now, the limousines may be used for a period of 5 years. After that, you may decide that we want to purchase newer models for our client. So at the end of that 5 year period, we're saying, how much can I sell that limousine for? That's known as the asset salvage value. It is the expected market value of an asset at the end of its useful life, meaning it is now fully depreciated. Okay? So there's something called depreciable cost for these long-term assets. That is the original cost of the asset minus any salvage value is known as its depreciable cost. So don't worry, we're going to take these words now and do some actual calculation. Now, there are different methods we can use to record this expense for depreciation. We look at three different methods: the straight line approach, the double declining balance, and the units of production. We're going to cover all three, but the straight line is the most widely used approach, so that's going to be our first method, called the straight line method of depreciation. With the straight line method, we're going to expense an equal amount of the asset's cost each accounting period. Meaning, if an asset has a 5 year useful life, we're going to expense the same amount each year over that 5 year period. With the double declining balance, this is an accelerated method where we're going to expense a greater portion of cost in the asset's earlier years and a lesser amount as the asset becomes older. And we'll explain why we would choose this method of depreciation. And then with the unit of production, it's going to be an amount, the expense will vary, depends upon the actual use of the asset in that period. Meaning, the more we use an asset in a certain accounting period, we're going to have a greater amount appreciated in that accounting period. Okay? So as I mentioned, the straight line by far is the most widely used method. So we'll spend most of our time focused on the straight line method of depreciation. So here we have some numbers, and we're now ready to begin some calculations. So you ready? You are? Great. Stay tuned for part 2 of our video lecture. Bye bye.